Hello guys, I'm Ejaz Khan, and in this video we are going to discuss one of the specimen exam questions of F9 for 2014 GWW company. GWW company is a listed company which is seen as a potential target for acquisition by financial analysts. The value of the company has therefore been a matter of public debate in recent weeks, and the following information is available. Profits have been given from 2009 to 2012, and then dividends as well. And we have been provided with the financial position of the company and some other information here, but most important is what we are supposed to do in this question is we have to calculate the value of GWW company. So when you're supposed to calculate the value of a company, it means it's a business valuation question. And which methods are we supposed to be using for valuation? Number one, market capitalization through equity market value. Then net asset value, liquidation basis, price earning ratio method using the business sector average price earning ratio, and then using the dividend growth model. So we have to calculate the value of the company using these four methods. So now let's go ahead with the first method, and that's market capitalization. And when they say market capitalization, it is basically where we calculate the value using the market price per share of the company. So just need to go to the question and see if there is any price given, which probably will be given because it's a listed company and it is supposed to have a market price per share. So the shares of GW company have a nominal par value of 50 cents per share and the market value of $4 per share. So each share is currently traded at $4. So we'll be using this price to calculate the total value of the equity. So market price per share, it is $4. And the par value, the face value of each share was 50 cents. That's $0.5. So $0.5. And then let's find out the total number of shares. And for this, we need to go to the balance sheet and see what's the total share capital value of the company stated in the balance sheet. Here we go. Ordinary shares, $20 million. And remember that the ordinary shares value is always reported based on the par value of the share and not the market value. So if the total value is 20 million and each share has a par value of $0.5, then what will be the total number of shares? So simply you have to pick the total value of the ordinary share from the balance sheet, which is 20 million, and you need to divide it by the par value of each share to find out the total number of shares. So it's 40 million number of shares, and obviously it's not going to be in dollars. It's the number of shares. So it's 40 million shares. Now the total value of the company, or we can say total value of equity or the market capitalization, whatever you call it, will be the total number of shares into the market price per share. There are total 40 million shares in issue, and each share is being traded at $4 per share. So the total value will be $160 million. That's the total market capitalization or total value of equity of the company. So this is the first part of the question. Now let's move towards the next one. The next one was to find out the total value of equity on liquidation basis. That is, if the company is liquidated today, what will be the value of the equity? Or we can say it's the realizable value method. So we are calculating the value of the company based on the realizable value of its assets. So first, let's write the current value stated in the balance sheet of the assets. Total value of assets. And it's obviously going to be in millions, as all the values are in millions. So the total value of the assets, non-current assets, 91. The total assets are quoted here, 99.3. So $99.3 million will be the total value of the assets. That's what is being stated on the balance sheet. Now we need to look at the other information if there is any appreciation or depreciation in the value of the assets in case the assets are sold. So let's read this information. The cost of the equity of the company is 9%, not relevant at the moment. The business sector of GWW has a PE ratio of 17 times. Again, it's not relevant at the moment. The 8% bonds are redeemable at nominal par value, not relevant again. The expected net realizable value of non-current assets and the inventory are 86 and 4.2 million, respectively, in the event of liquidation. Okay. So there were three assets given in the question: non-current assets, inventory, and trade receivables. So they have given us the realizable values of non-current assets and the inventory value. So let us not write the book values because we have been given realizable values of non-current assets. And the non-current assets have a value of 86 million. That is, if the assets are being sold today, they will only realize $86 million. And realizable value of inventory, that is, if inventory is sold today, will have a value of $4.2 million. $4.2 million. Whereas the receivable balance given on the balance sheet is 4.5 million, but according to the question, only 80% of the trade receivables are collectible. That means 20% will be bad debts not adjusted in the balance sheet. So we have to adjust it by multiplying 4.5 with 80% so that we can get the realizable value. So $3.6 million. And let's add all these three values. So we'll get the total value of assets. $93.8 million. Now that's not the value of equity, that's the value of its total assets. For calculating the value of equity, we have to subtract the value of debts. So there are two types of debts given in the question: the non-current liabilities and the current liabilities. So non-current assets have a value of 25 million, and the current liabilities have a value of 7.1. So let's add these two values, and by adding these two values, we will get the total value of the debts. Because if these assets are sold, out of these assets, these liabilities will be settled. So whatever is left after deducting the liabilities will be the value of equity. So the total value of equity, that is the value of the shareholders, will be 61.7 million dollars. And that's what we have calculated using the realizable values of assets. I hope you people have got that why we have subtracted the debts, because of the total assets, if these assets are being sold, obviously the liabilities will be settled first. And after settling the liabilities, whatever will be left will be the value of shareholders or the value of equity. So we are done with two methods. Now let's go to the third method, and that is value of equity using the PE method, price earning ratio method. So for price earning ratio, we need earning per share of the company, earning per share. So to calculate the earning per share, we need the total earnings after tax for the business. And here we go. As per question from 2009 to 2012, the earnings of the company have been 8.5, 8.9, 9.7, 10.1 respectively. But we have to pick the latest figure for the earnings, which will be most relevant figure. So 10.1 million earnings are there for the business in total. And we just need to divide the total earnings or the total profit after tax by the total number of ordinary shares. And we have already calculated the total number of shares, that was 40 million. So let's divide it by 40 million to find out the earning per share. The earning per share is 0.2525 dollars, and if we just round it off to two decimal place, it will be 0.25 dollars. That's the earning per share. So once we have the earning per share, we need PE ratio for calculating the value of the equity. And PE ratio, as per question, should usually be related to a competitor which is similar to the company for which we are calculating. If we don't have any competitor information who is similar to this to our company, then we can use average price earning ratio of the sector or the industry. So in this question, it's 17 times. The business sector of GWW company has an average PE ratio of 17 times. Now remember one thing, that the best PE ratio will be of a company which is almost similar to GWW company. So we don't have any similar company in this question. Therefore, we will be using the sector's price earning ratio, that is 17 times. So if in the market, every investor or investors are valuing the company 17 times of its earning, then the value of the GWW company's share price will be 17 times of its earning. So market price per share, as predicted by the price earning ratio, will be 17 times of the earning per share, because this is what the trend in the market is. So it's $4.29 per share. This is the price predicted by the PE ratio. And remember, whenever we use a formula, whether it was that's the second method or it was any other method which uses a formula for calculating the price rather than picking up the price from the market. So whatever formula we use for calculating the market price, that method will be called theoretical method. In the first part, where we use the actual market price, This is the practical market price of the company. This is what is actually prevailing in the market. But these values are the ones that we have calculated using formula or any theoretical approach. So that's why these will be the theoretical values of the company. So 4.29 is the theoretical market price of the company predicted by the PE ratio. And if we need to find out the total value of equity, we have to multiply it by the total number of shares. 4.29 multiplied by 440 million, and it will be $171.1 million. That's the total value of equity predicted by the PE ratio. We could have easily calculated this value by simply multiplying the PE ratio with the total earnings of the company instead of the earning per share. If we have the total earning, we can simply multiply the total earning figure by the PE ratio to find out the total value. So the total earnings were 10.1. So if I multiply it by the PE ratio, I'll get the same figure as above. Now the question may be, why did I calculate the earning per share then? Now, earning per share is useful where the question asks us to calculate the per share market price rather than the total value of equity. So where we are required to find out the price of each share, then it's better to use earning per share, because by multiplying earning per share with the PE ratio, we get per share price. But where we are supposed to calculate the total value of equity, we can simply calculate the total value by multiplying the total earning figure by the PE ratio, as we did it here. So I hope it's clear now. So you can use both the methods to find out the total value of equity. It's totally up to you. Now, the last method for calculating the value of equity was, let me check which method was that. It was the dividend growth model. Now we have to use another theoretical model to find out the value of equity by using dividend growth model. It's a theoretical model, and there are a few variables that we need to use to find out the market price per share using the dividend growth model. So we need dividend per share, DPS, dividend per share, and it should be the current dividend. We need growth. And we need cost of equity. We need these three variables to find out the market price per share. So let's find out dividend per share. Again, they haven't given us dividend per share, but they have given us the total dividend that they have paid. And it should be the latest dividend that we have paid. And since we are at the end of 2012, so the latest dividend figure will be $6 million. Remember, this is the total dividend, not the dividend per share. So in order to calculate the dividend per share, we have to divide 6 million, the total dividend figure, by the total number of shares, 40 million. So it's $0.15 per share. We can also use the figure in cents. It won't make any difference. But remember, if we use cents figure for DPS, then the price calculated will also be in cents, and we may have to calculate it in dollars by multiplying by 100. Since we want the market price per share ultimately in the dollars, so I'm just keeping the dividend per share figure in dollars. Then comes the growth rate, and first let's see whether the growth rate has been given in the question. There is no growth rate given in the question, so we have to calculate the growth rate. So the earliest dividend figure was 5 million, and the latest dividend figure is 6 million. So the dividends have grown from 5 million to 6 million, at a specific growth rate that we need to find out. For this, we will be using compound growth rate formula, and the compound growth rate formula uses the earliest dividend figure and the latest dividend figure. So to find out the growth, we have to divide the latest dividend figure, which is 6 million, by the earliest dividend figure given in the question, which is $5 million. And we will simply ignore any dividend values in between. So divide by 5 million. Okay, then we need to take a power. And after taking the power, we should write 1, and we should divide it by the number of years between these two dividend figures. So how much time did it take for 5 million dividends to grow from 5 million to 6 million? We need to find out the number of years between these two dividend figures. So 1, 2, and 3. So from the end of 2009 to 2010, it was 1 year, then 2 years, and then 3 years. So there were 3 years between these two dividend figures. So 1 upon 3. And once we get this answer, from this we have to subtract 1, and we just simply need to enter. Now this figure isn't in percentage. So all you have to do is to either multiply it by 100, which is not recommended. If you are using spreadsheet, it's better to use the format option of spreadsheet. So convert this into a format of percentage, which will be given in your exams. So take a percentage. So it is going to be 6.27%. So the growth rate has been 6.27% in last 3 years. And we are expecting the same growth rate for the future as well. So now we have got the growth rate. Now comes the cost of equity, which is given in the question, and that is 9%. And remember, whenever we are using cost of equity, it should be of the same company for which you are finding out the value. Since we are finding out the value of GWW company's share, therefore the cost of equity should be of GWW company, and it is 9% in this case. So it's 9%. Again, we need to convert it into percentage format, 9%. Now let's find out the market price per share using the dividend growth model. And the formula for dividend growth model is the current dividend into 1 plus G. Why we are multiplying it by 1 plus G? Because we need to find out the next year's dividend. So the numerator value should always be representing the next year's dividend. Since we did not have the next year dividend, we have used the current dividend, and by multiplying it by 1 plus G, we are actually converting it into the next year's dividend. So remember, if the question gives us a dividend for the next year, then you do not need to multiply it with 1 plus G. Just simply put the next year dividend and do not multiply it by 1 plus G. Okay, after multiplying it by 1 plus G, we need to divide the whole figure by KE minus G, and this will be done in every case, whether it was the current dividend or it was the next dividend. We have to divide it by KE minus G. So that's the price, $5.83 predicted by the dividend growth model. This is the per share price. And in order to find out the total value of equity, we have to multiply 5.83 by the total number of shares, that is 40 million. And the total value of equity predicted by the dividend growth model is 233.2 million. And if we round it off to 0 decimal place, it will be $233 million approximately. So we are done with all the 4 methods. Thank you for watching. Bye-bye.